In this video we are going to explore a long trade idea in the British pound versus the Japanese yen in the 15-minute timeframe. By doing a simple high and low count in this chart, we can quickly identify the relative major and minor flows. Number 1 to number 2 is a major vector down, number 2 to number 7 is a major vector upward, and number 7 to number 10 is another major vector down. Everything inside these three major vectors can be considered part of the minor flow of this market. Observe that in terms of the major flow, low number 2 is a solid market structure because number 7 clearly surpassed high number 1. That's just basic logic applied to raw price action. If number 2 up to number 7 forms one major upward vector, then number 2 is the origin of that vector. The buyers that originated the vector in number 2 were clearly stronger than whatever happened to generate high number 1. In terms of the minor flow happening inside this larger vector upward, we can see that's the case in low number 4 and low number 6, which are both confirmed market structures in the minor flow. We have to be careful to not mix the solid structures of the major flow with the solid structures of the minor flow. Notice that high number 9 was a buyer's attempt to render low number 8 as a solid structure, but buyers were simply not powerful enough to accomplish that feat. Since high number 9 is a failure to surpass high number 7, the market realizes this and starts to fall right after number 9. This is where things start to become a little complicated and subtle to the amateur trader because there are things in the chart that are not obvious nor self-evident at all. Notice that the failure of number 9 is happening inside the minor flow of this market, so the next logical area we should be paying attention to is the area around the confirmed major structure number 2. However, professional price action reading is not just about seeing what price does in certain levels. It's also about seeing how price reaches these important levels as well. If you take a closer look to the vector from number 9 to number 10, you will be able to see that all candles have lower highs without any exception. This is not exactly a coincidence because price action tends to be much more chaotic than that most of the times, so we should be cautious when we see organized behavior like that in the chart. This is a classic market maker signature that is simply glossed over by most traders. Organized behavior like that is a clue that large traders are probably attempting to push this market down on purpose, but the catch is that they will probably only do this up to a certain point in order to push unaware traders off the cliff. What I mean by this is that when amateur traders see price falling hard after high number 9 in the direction of low number 2, they get agitated to sell the market in that level. That's precisely what market makers want these traders to think, because they need to hit a cluster of orders to get in large positions in the exact opposite direction. In other words, market makers need a lot of stop orders being triggered in one direction so they can enter in the opposite direction. This is known as a liquidity burst, and that obviously happens at the expense of retail traders. As expected, this is exactly what happens in candle number 10. The small poke of that candle in the low number 2 level is enough to push retail traders off the cliff and create a liquidity burst, or a window of opportunity for large traders to get in the market. If you are a retail trader at this point, you are completely screwed, but if you know how large traders think, you will be expecting the right moment to trade with them. That can be fully understood in my course about the market maker strategy that is available in my strategy store in case if you really want to understand how all of this works in great detail. Beyond all of that, in candle number 10 we also see a price action formation called fractal candle, which is ironically derived from a momentum indicator. Fractal candles usually happen in major and minor reversals of the market. We can also see that there is some sort of cascading reversal divergences happening in the last minor lows before candle 10, which is another indication that agrees with the idea of market makers in here. I also drew an upsloping pitchfork in the chart to add yet another dimension to the analysis. Notice that the fork is drawn using three major alternating price extremes: the low number 2, the high number 7, and our potential low number 10. Pitchforks are derived from Newton's third law of motion that claims that every action has an equal and opposite reaction. In this case, the action of the pitchfork is between the center line and the upper line coming out of number 7. Notice how the pitchfork cuts through low number 6 and low number 8 in a nice way. This sort of symmetry is one of the many details that go along with pitchforks, and the action between the center line and the upper line of the fork is what can predict the reaction on the opposite end of the fork, which is potential low number 10. So if we combine the organic price action reading, the identification of the manipulation maneuver potential, the fractal candle reading, and the geometry unveiled by pitchforks, we have a context for a high-quality trade opportunity. The trigger for this trade was at the close of the fractal candle number 10, so a long trade position was opened at the beginning of the next candle. The stop loss is below the lower tail of candle 10, which is a double protection from the market maker's poke and the solid structure number 2. If we are correct about this reversal points, this is definitely the best place to put a stop-loss order without guesswork. The target will dynamically follow the center line of the pitchfork because price has an 80% chance of hitting that center line once it starts creating a minor flow in that direction. This also fits very well with the major guideline of looking for trades that have at least a 1-to-3 risk-reward ratio. Let's see how price develops. Observe how the dynamic target of the trade is hit almost perfectly at the center line of the pitchfork, and therefore rendering this trade as a successful 1-to-4.3 risk-reward ratio. I hope you enjoyed this video. If you want to learn how to read the market like this and make precise trades like this one, please visit the strategy store in the link available in the video description. If you wish to see more videos like this in the future, please support the channel by clicking the like button, subscribing to the channel, and leaving your comment below. Thank you for watching and I hope to see you in the next videos.